Brian, let's get into the inbox here. Got an email from Mark. He says, my wife and I are from the Bay Area and are thinking about moving to your area. Our capital gains taxes are going to kick us in the teeth as we sell our business. Taxes on $3.5 million on the business.
Wow.
$1.3 million on the building.
That's their gain. Is $3.5 million.
I guess.
Yeah.
It says when we're in our late 50s, what can we do before we move to your area? So $3.5 million on the business, 1.3. So gains on the building.
1.3 on the building, the office or whatever.
Yep. So you're looking at 4.8 total.
Wow. I mean, it's a good problem to have. It's just it is a problem.
Yeah.
I mean, going from the Bay Area to anywhere, I mean, they're already going to be a step ahead because they're going to have this value transfer, right? They're going to be able to be a king in a area like ours, right? I mean, you can buy a 150-acre tract of land and be 20 minutes from a city and still have a nice, decent house. I mean, it's just crazy the value of what they're probably living in this little teeny house. It's small, so that's not even including their house. That's
That's just the business.
Well, yeah, they may not have that much big a gain on their house too, so they might not pay any tax. But they
didn't mention the house here, but I'm sure that goes.
Well, I mean, a lot of people with real estate can easily do a 1031 exchange. That's pretty simple. I mean, you pay a qualified intermediary maybe $1,000, right? We work with a firm that we set you up, make sure that the language is in there. You do a 1031 exchange, and you can take that $1.3 million building. Well, that's the gain, actually, I think she was talking about, right? So there might be more asset. But the point is that you're moving that over. You're exchanging it for like kind, right? And a lot of real estate investors know about these. A lot of them haven't done them. But this is where we step in to give the advice, right? Because it's not just, now I got to go find a property. I want to retire, right? We want to buy a property in Virginia that has some horses and we can, have fun with our grandkids and we want to enjoy life, right?
Can they do that from state to state, that 1031 exchange?
Yeah. Oh, yeah.
So they can do it from the Bay Area to...
Yeah, absolutely.
Okay.
Yeah. Doesn't matter that you don't stay in the same state. And I mean, California tax is crazy.
Oh, yeah.
Gosh, I was just talking to another real estate investor, funny, about their business owner that's can't wait to get out of... Well, it was Oregon, but it was their taxes are very similar, and it's crazy the amount of tax. So,
and then you got the tent cities you got to deal with too over there.
Yeah,
there's a lot of people migrating.
Right? Why do they want to get out? There's a reason. The regulations, the tax, it's insane. So, but the point is that you've got a federal capital gain of 20%. It's bracketed, right? But the point is, real quick, it gets to 20%.
Okay.
So you got federal at that. Then you got the net investment tax. That's another 3.8%.
Oh,
that's fun. I think it was Obama that created that. But anyways, then the California.
Thanks for that.
Yeah, that really helped out the program. And then the top tax bracket, which at their case, capital gains could be as high as 12.3, but you got to really get your income up there. I mean, it's got to be high. And this year they would. I mean, with 4.8 million. So yeah, a lot of it would be at 12.3%. So that's a crazy state tax. And so when you add that in, I mean, 32, 35. 36%.
Good grief.
So, yeah, you're almost giving, you're over a third.
They're right to ask the question, huh? They have a right to be concerned.
Right. So, anyways, getting back to what do we do? I mean, there's a lot of things you do. The real estate can be 1031 to a Delaware statutory trust, or you could buy another property if you can find one that you want to buy. So, we work with a lot
of... buy like 5 here for that.
Right. So, we're trying to educate real estate agents that are commercial agents and attorneys when they have someone, they're like, well, we can't find another property. Well, that's okay. We can find you a property to put it in. There's billions of dollars of real estate to list it. Once you sell it, here's how it works. You got 45 days after you sell it to identify 3 properties. Okay. So let's say you don't
That's
find,
not a lot of time, is it?
not really, but if you can't find something, but you have a backup plan, let's say we found 3 properties, you got self-storage units over in Florida, you've got Charlotte, you can go buy whatever, an Amazon warehouse, industrial warehouse, where Amazon's going to be your tenant. I think they're going to pay. You've got maybe some
good rent out of that.
Student housing in wherever, a college town in South Carolina, right?
Okay.
Whatever. You could be near a university or whatever. And a lot of these real estate classes have done 10 to 14% over the last 20 years. That's pretty good.
Yeah.
And lower risk than a lot of the bond funds out there that are in the stock market. So you got double-digit returns that have happened. Doesn't mean it's going to happen in the future, full disclosure. But you are tax deferring it over to another thing, right? You're investing in another real estate investment, so you don't have to pay the tax. And if you pass it on to the next generation, then it's passed on tax-free. People are like, oh, well, that's a lot of risk. Really? It's actually probably more low risk than your stock portfolio and your 401k.
Yeah, right.
And we can prove it, right?
Yeah.
There's standard deviation we can measure. The $3.5 million, the business can go into other things if we know ahead of time before you sell the business, right? So if we're going to do charitable planning, we can transfer units of the asset into a charitable trust to eliminate the tax, get income in retirement, pass it on to the next generation, and get them have income. So you could do a pooled income fund. You could also do a deferred sales trust, which is basically a part of the code where you get an IRS, you get a tax stream, or you get an income stream for the rest of your life, but you don't pay $3.5 million. I mean, you're going to pay through the nose on this whole property. I mean, it's just insane what you're going to pay. So you can defer, eliminate, or minimize the tax. You could also do a qualified opportunity zone to eliminate the capital gains even after you close. So a lot of people are like, oh, Brian, I missed the boat. I listened to your show. I had one guy tell me this. He goes, I listened to the show and we paid, we're going to pay about $500,000 in tax. We heard about you too late. And I was like, well, when was it? He's like, well, it was 3 months ago. I'm like, well, that's not too late. We can still fix it. We can still get it fixed. Just get your butt in here and we can do it. And we did, we can do some qualified opportunity zones where people are like, oh, isn't that kind of risky? I mean, it's real estate. I mean, you've built the wealth in real estate. So there's a lot of things you can do. You just need to start planning now, especially if you're planning on exiting soon.
Sounds like, Mark, you have some options. So I don't know where you're listening to the show. Maybe he's listening in the Bay Area, but feel free to call Brian and his team at Integrity Financial Planning, 866-2-PLAN-4, 866-TO-PLAN, and the number 4.